So we're going to look at SPY. It's an index fund for the S&P 500. We're going to look over the last 29 years how this has been impacted to really give a good understanding of the ups and downs of the stock market and how it impacts you, and how if you sell when things are going down, that's the biggest mistake you can make. And unfortunately, that's human nature. So join me as we take a glance at the year by year of SPY. And we're going to use some scenarios here. We're going to pretend that we started out with $1 in balance and we've started contributing $10,000 a year. You can plug in any numbers you want, but this gives you an example of how the ups and downs of the year's return impacts your overall balance. Now, again, most people are not contributing $10,000 in a lump sum at the end of the year. This is how this is set up just for convenience. Most people are putting in weekly, biweekly, or monthly amounts. And so you'd have dollar cost averaging on those percentages a little bit. But this should give you a general overview of how that impacts you, because the ups and downs are averaged for the year and how the year turned out. So we're just going to look at back in 1995. Here are the first screenshot we have here. Starting balance 1. That year, the S&P 500 returned 38%. If you contributed $10,000, your ending balance would have been $13,808, and your cumulative interest would have been the $3,808. So, starting out, you'd be like, wow, this is great. As you can see, for the next few years, there are some really positive returns. So you're seeing your contribution of $10,000 each year. You're seeing your starting balance for the year growing. By year 5, you're up to $80,000, and you've only contributed $50,000. You're getting that accumulation, and then at the end of that year, because you had a 20% return that year, your ending balance is $108,000, and your cumulative interest for all these years so far now is $58,000. That's great. That's a fantastic 5-year spree that this went on. But then you can see reality hit. We have our dot-com bubble here that took place, and stocks and S&P 500 were hit pretty hard, a negative almost 10%, almost 12%, and then 21.5%, 3 years in a row. And that cumulative impact, as you can see, is tremendous. You're still contributing your $10,000 each year. So at the end of this 8th year, now your ending balance is $88,000. And this is where people will look. Year 5, they're sitting going, wow, I'm at $108,000. This is great. I love the stock market. I'm going to buy more and more and more. But then you have some bad downturns like this, and they sit and go, I'm losing everything. I've lost so much money. No, you haven't lost anything, because you're still in the market. As you see, you still have $88,000. You've contributed 80 of that. You've actually still gained $8,800. I know it feels like you've lost this $50,000 and you're down to $8,000 here, but that's not the case. This is the gain that you had. You have never received that money because it's still sitting in your portfolio. It's unrealized gain because you haven't taken it out. You haven't sold. Now, if you sold here, you would have been sitting nice. And then if you sit back and wait for 3 years and then buy here, you would have been doing great. But nobody can time the market. I want to take a quick break here and remind you to get onto Pocket Guard. It's a great way to begin your budget, to start looking at ways of controlling your money so you can make these sound investments. There's no sense in talking about the S&P 500 if we can't get on a budget and have money to invest in the first place. Great thing about Pocket Guard is they have a free version. As you can see on my screen, I've listed some of the things that you can get on the free version. You have the recurring income ability. You can do your bills. You have the category budgets that are set. You can set goals, and you have the insights and transactions functions. I've talked about some of these on other videos. Check out the playlist or look at the link in the comments below, and feel free to check out Pocket Guard for yourself. And if you don't want to use just the free, you have the premium. The premium is rock solid. It's loaded with great features. You can have unlimited bank connections. You can set debt payoff plans. I did a whole video on that recently. Check out that video. You can create your own categories if you have special things that you want to make sure that you're categorizing. change the date of external transactions, and you can export transactions and import transactions, extended transaction history. So much you can do. You have unlimited savings goals, unlimited category budgets you can create, split transactions into different categories. Maybe you went out to eat, maybe part of it you want to put on business. I don't know. You can set it up any way you want. You can attach receipts so you have all your receipts in one place. Great option by setting up for the premium. They even have a one-time lifetime fee, which is great. Buy it and you're done. Check out Pocket Guard below. Now back to what we were talking about on the S&P 500. Typically what happens is we're riding this high. We love this here, $58,000 of interest in 5 years. But then we see it starting to go down. And somewhere in these 36 months, people begin to panic. This is where the panic selling takes place. This is where the emotion kicks in on investments, where people have to realize you're in it for the long term. If you started here and you're 35, here you're only 43. You don't need this money for another 20 years. So why are you panicking? What are you worried about? You're still up $8,000. This is where you can't panic and you can't let the market dictate your outcome by selling when prices are down. That is what happens. Somewhere in here is where people start panicking. So they sell, and then these down losses is they lock it in. Maybe you lock it in here. You sell in year 7, and now you're, instead of up 58,000, you're only up 33,000, but you locked in that. And then you start looking and you see it start rising here. So you maybe get anxious again. You're missing out. So you buy when it's starting to go up instead of continuing to buy and investing this 10,000 here when those prices are lower, which is going to give you a greater yield on cost on the stocks that you buy this year. It's a wonderful thing that you have to realize that it's going to happen. So let's continue to play this 29-year scenario out and see what happened. If we didn't touch it, we just looked and saw, oh, we're really down. Well, the year after, if you just stuck it out, hang tight, don't panic, you started out at $88,000, but that year there was a 28% gain. Again, you contributed your 10,000, so now your balance is back up to 126,000. And look at that, your cumulative interest, what you have earned, not what you've put in, is 36,000 of this. So you're gaining back some of that really quickly, because typically after a really bad downturn, there's some really good years because the stock market recovers. And so if you just hung tight, you would be in decent shape again. Still, you're not here, the 58,000 that you were a few years ago, but this is a pretty bad, very unusual scenario that happens, and it happens occasionally. And this is where you have to just weigh it out and say, I'm in this for the long term. Now, if I was 62 years old when this happened, yeah, that would be a bit more concerning. But still, when I'm 65, it's bouncing back. So you have to determine how far in advance prior to needing this you want to get more conservative to not have these big ups and downs. And that's where we'd look later down the road. So let me scroll this up a little bit here. So as you can see, after that 3-year downturn, there's some decent years. A couple mediocre years here, 5% almost, a little over 5%. Here's a pretty about average year. Very few years are average. You got a 15, 15, 15, 13 here. You got a few that are right in the average over a 10 or 20 year range. But you have your highs and some mediocre, and then your really lows. So you can see after that 3-year downturn, you had nice couple returns. Now you're back. And now your cumulative interest is up to $98,000, where before it was up to $58,000. But again, here's where people panic. So again, you started when, say you were 35, now you're looking at you're 47, and this year here hits. This is the housing bubble. The housing market crashed and the stock market followed. It was just a really bad year. Everything went bonkers there for a little bit. And that happened, and the S&P 500 dropped almost 37%. Now, you've been consistently putting in your $10,000 annually. your balance at the end of this dropped from 228 to 150,000. But look, you have still made $10,000. The choice is, are you going to panic here? Because you see this, is it panic time? I've lost everything. Oh my gosh, the market's down 37%. I've lost it all. No, you haven't. You've actually still up $10,000 on your investment. Your 150,000, so 140,000 of that has been your contributions. So your contributions are still safe. And here, you still have $10,000 that you've earned. If you hang tight, ride the wave, realize this is normal. Don't listen to the media and all the hype. It's time to get out of the market. Don't buy in the market, etc., etc. If you're in it for the long term and you're diversified in something like the S&P 500, which is 500 of the top stocks in the stock market, you're well diversified. Yes, it took a big hit, but look, 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive years after that. And there's some big positives of 26, 32, 22% almost there. Look what happens. You could have bailed, said, I'm out, I'm done, I can't handle this, and you lock that in. Look at this. You were happy here when you're at 98,000, just like you're happy back here at 58,000. But when it got to 8, you were freaking and panicking. Here you're happy again. You're greedy. Oh, I got 98,000. Now you're scared. You're going to sell. You're down to 10,000. So you're locking in those downturns. Instead, you wait. Yes, it takes a couple years, but look, now year 18, a few years after that, you're back on top, $133,000 worth of profit, of gain, of interest. Your principal has not been touched yet. It's still intact, and you've never gone below 8,000 in this scenario of gain. And then again, you drop down to only $10,000 of gain, but it's still gain. And if you held tight and didn't panic, you had great return. And then before the next down year, now again, we had some pretty measly years here and here, 2%, 1.25%. But you look here now, year 23. So now you're 58 years old. You have $750,000 in your portfolio, and almost 500,000 of that is cumulative gain. That's what happens. Patience. It comes back. You have to ride the lows in order to gain the highs. But most people emotionally sell when it's low and then buy when it starts climbing. Back in here, they sold, they're scared, then they don't buy. They start seeing the market take off. They're sitting on the sidelines and they see this, oh, I'm going to get in, and they've missed all this rebound. They locked in that low instead of, hey, when it's down here, I'm buying more because I'm getting it on sale. I'm getting it cheap. And then boom, I get that 26%. I'm getting that dollar cost averaging on that return. Again, back to year 18. Then we have a slight down year. Most people can swallow that even though they complain and don't like it. You're still up $460,000 of gain. Let's just see how we finish out over this 29 years. This has been the SPY index fund and how it has performed over the last 29 years. Look at this. After that small downturn, you have 31, 18, and 26%. Look what happens. Your balance goes from 700,000 up to 1.4. It doubles in just those couple years. And look at your interest. This is your gain. You've contributed that $10,000 for 27 years. It's $270,000 you've contributed, but you're at 1.4 because you rode those lows, didn't panic. Look where you're at. Again, 2022 was a really bad year. People have been complaining and saying how bad it was. It was down 18%. So yeah, they're looking at this saying, oh, I'm down. Look how much I've lost. No, you're still up $900,000. Your investment has gained. You didn't contribute this $1.2 million. You only contributed the $280,000. This has all been interest gain. Big deal. We have a down year. Look at 2023, the SPY fund. Continue to put your $10,000 in. Now your balance is back up to its all-time high of 1.5. You're at $1.2 million of interest. This is how riding the wave out. Not once during this 29 years has your principal been lost. Have you lost it all? You have simply rode the wave out and you have accumulated wealth. If you continue to ride this out another 10 years, we don't know what the future holds, but I can probably go off the past and indicate that this is going to drop. It may drop significantly, but if you hold on and wait, it's going to rebound and then gain even more. Look at that. You dropped to 8,000. It was horrible. Panic, freaking out. Boom. Now you're up to 98,000. Oh no, I'm down to 10,000. I'm panicking. I'm freaking out. Boom. I'm right back to where I was and then some. And then because the market continues to grow, it accumulates quickly. Another little downturn. Oh, I'm panicking. I'm going to get out. Nope. Stay in. It's back up above where it's ever been. What's 2024, 2025, and going forward going to hold? We don't know. But you're in the market for the long term. Buy and hold. If you want to speculate, if you want to trade, you may as well go to Vegas. You may as well go gamble. Buying stocks for short term, trying to flip them and turn them and make money is how you lose. Stay with the long-term investment. Be diversified. Don't look for just one stock that you think is going to be the granddaddy jackpot. Diversify in funds, diversify in segments. Make sure your portfolio can ride and sustain the waves. It's not putting all your eggs in one basket. S&P 500 is a great way to diversify. And here you have an example of 29 years. I hope this has been helpful. Hope it encourages you, if your portfolio is down, to ride the wave, to make sure that you don't panic and stick it out for the long term. Thanks for joining us, and we'll see you next time on Simply Money.